You cannot run an artificial intelligence empire on thin air. While the world is mesmerized by chatbots and generative art, the smartest money on Wall Street is quietly exiting the software trade and pouring billions into something much more tangible. They realized a brutal truth. The gold rush isn't about the gold anymore. It is about the heavy iron machinery required to dig it up. If you are still betting solely on the companies writing the code, you are missing the massive physical industrial revolution that makes that code possible. Hi, I am Sean. Welcome back. In the next few minutes, I'm going to show you how to look past the hype cycle and identify the 4 hidden engines driving the American market right now. Let's dive into the first reality check. We call this the physical reality of AI. There is a massive misconception floating around the retail investor community. People think of AI as this ethereal, cloud-based magic that lives on our screens. But the cloud is not a cloud. The cloud is land, it is steel, it is copper, and most importantly, it is electricity. Think of it this way. During the California gold rush of 1849, the people who became consistently wealthy were rarely the ones panning for gold in the river. It was the merchants selling the pickaxes, the denim jeans, and the tents. Today, history is repeating itself, but the scale is terrifyingly larger. Here's the data that changes everything. A standard Google search uses about 0.3 watt-hours of electricity. A single ChatGPT query uses nearly 10 times that amount. Now, multiply that by billions of queries a day. We are not just talking about a software upgrade here. We are talking about a physical strain on the United States power grid that we have not seen since the industrial age. This brings us to the investment thesis that the big funds are obsessed with right now. It is what I like to call the lung theory. An AI data center is like a living organism. It generates an incredible amount of heat. If you cannot cool it down, the brain dies. The chips melt. The empire collapses. This is why companies that specialize in thermal management and industrial cooling are seeing their order books filled for the next 5 years. We are seeing legacy industrial firms, companies that handle air conditioning and liquid cooling systems, suddenly trading like high-growth tech stocks. They are the lungs of the AI revolution. Without them, the NVIDIAs and Microsofts of the world literally cannot function. But it goes deeper than just cooling. We have to talk about the fuel. The US power grid is old. It is creaking under the weight of this new demand. The tech giants know this. That is why you are seeing Amazon buying nuclear-powered data centers. You are seeing Microsoft making deals to restart dormant nuclear reactors. They are terrified of running out of juice. So when you are looking at your portfolio, ask yourself a hard question. Are you betting on the software that might be replaced by a better version next week, or are you betting on the physical infrastructure that has a monopoly on survival? The software is the car, but the infrastructure is the road, and the toll booth always makes money. Now, while the physical infrastructure build-out is obvious once you see it, there is another mechanism at play in the market that is much more subtle. It is a mathematical trick used by some of the most successful American companies to make you richer while you sleep, without you lifting a finger. It is almost like a cheat code for the stock market. Let's talk about this cheat code. In the hallways of Wall Street, we have a nickname for these types of companies. We call them Cannibal Stocks. It sounds aggressive, and honestly, it is. It is the most aggressive way a company can love its shareholders. Most beginners obsess over dividends. They want that cash payment hitting their account every quarter. But the ultra-wealthy understand that dividends come with a drag: taxes. Every time you get paid, the taxman takes a cut. The Cannibal stock uses a different strategy: the mandatory share cancellation, better known as the aggressive buyback. Imagine you and 3 friends order a pizza cut into 4 slices. You each own 25% of that pizza. Now, imagine the chef comes out, takes 1 slice away, and throws it in the trash. The pizza didn't get bigger, but suddenly you own 33% of what is left. The chef does it again. Now you own 50%. You didn't pay a penny more, you didn't do any work, but your ownership stake doubled. This is exactly what companies like Apple and AutoZone have been doing for years. Let's look at AutoZone. It sells car parts. It is boring. It smells like motor oil and rubber. Yet, if you look at its stock chart, it looks like a tech rocket ship. Why? Because they relentlessly buy back their own stock and delete it from existence. Here is the math that creates the magic. It creates an artificial scarcity. Even if the company's net profit stays exactly the same, 0 growth, but they reduce the number of shares by 10%, the earnings per share, or EPS, automatically goes up. Wall Street algorithms read this rising EPS and bid the stock price higher. It is a mechanical staircase to wealth. So when you are scanning the market, look for the share count line on the financial statement. Is it going down every single year? If the answer is yes, you have found a management team that is obsessed with making your slice of the pizza bigger while you sleep. They are doing the heavy lifting for you. However, once you find these incredible companies, the infrastructure giants and the share cannibals, you are going to run into a massive psychological wall. You will look at the chart, see that it has gone up 300% in the last few years, and you will freeze. You will say, Sean, it is too expensive. I missed the boat. It is at an all-time high. This is the single most expensive mistake in investing, the fear of heights. What if I told you that a stock trading at an all-time high could actually be cheaper than it was when it was trading 50% lower? It sounds like a paradox, but it is actually just simple math that most people get wrong. We need to talk about price distortion. Let's break down this paradox. We have this instinct wired into our brains from our ancestors that says, what goes up must come down. It applies to gravity, but it does not apply to corporate earnings. Here is the trap. You open your brokerage app, you pull up a chart, let's say it's a major US tech giant, and you see it trading at $500 a share. Last year, it was at $200. Your brain screams, it is too expensive. I will wait for a dip. You are anchoring your perception of value to a past price that no longer exists. But price is just a number on a screen. Value is what you get for that number. Imagine a machine that prints $10 a year, selling for $100. A few years later, that same machine is selling for $200. It looks twice as expensive. But now, that machine is printing $50 a year. Mathematically, the price went up 2 times, but the value went up 5 times. At $200, that machine is actually vastly cheaper than it was at $100. This is exactly what happened with companies like Meta and Nvidia during their massive rallies. The stock prices were skyrocketing, hitting all-time high after all-time high. The amateur investors stayed on the sidelines, terrified of the height, but the professionals were buying aggressively. Why? Because the earnings, the actual cash the companies were generating, were growing faster than the stock price. This is where you need to use a tool called the PEG ratio, price to earnings to growth. If a company has a high PE ratio, but is growing its earnings at a violent pace, that expensive stock is actually a steal. So stop looking at the price chart in isolation. A chart only tells you where the price has been, not what the business is worth today. If the fundamentals are improving faster than the price, buying at an all-time high is not chasing, it is recognizing reality. Don't let your vertigo cost you a fortune. Now, up to this point, we have talked about massive AI infrastructure, financial engineering with buybacks, and high-growth tech valuation. It all sounds very high-tech and sophisticated. But here is the twist. Some of the most explosive returns in the American market right now are coming from places you would never expect. Places that are low-tech, boring, and frankly, kind of mundane. We are talking about burritos, salad bowls, and skincare. There is a rebellion happening in the low-tech sector, and it is creating a new class of millionaires who realized that you don't need a microchip to build a compounding machine. Let's look at the humble burrito or the salad bowl. You might walk past a Chipotle or a Cava and think, that is just lunch. But Wall Street sees something completely different. They see a logistics company masquerading as a restaurant. This is the low-tech rebellion. While everyone is distracted by the latest AI chip release, companies in the most boring sectors imaginable are quietly revolutionizing their operations to achieve tech-like profit margins. Take Chipotle, for example. They didn't just sell tacos, they built a digital ecosystem. They introduced the Chipotlane, a drive-through dedicated solely to digital orders. They realized that if they could separate the digital assembly line from the physical one, they could double their throughput without doubling their rent. That is not just cooking, that is pure industrial engineering. It is the same efficiency logic that Amazon uses in its warehouses applied to guacamole. And look at the broader trend. We are entering the era of the GLP-1 economy, the weight loss drug revolution. People are eating less, but they are eating better. They are shifting away from processed junk toward fresh, high-protein options. This tectonic shift is propelling brands like Cava to valuations that make zero sense if you view them as just restaurants, but make perfect sense if you view them as high-growth lifestyle platforms. The lesson here is simple. Innovation is not exclusively silicon-based. A 10-bagger stock, an investment that goes up 10 times in value, is often sitting right on your dinner table or in your bathroom cabinet. These companies have pricing power, they have loyal customers, and most importantly, they generate cash today, not in some hypothetical future. So, where does this leave us? We started this journey by saying you can't run an AI empire on thin air. And that is the thread connecting everything we have discussed. Whether it is the massive cooling systems and power grids keeping the data centers alive, the aggressive share buybacks that mathematically force stock prices higher, the earnings growth that justifies buying at all-time highs, or the operational brilliance of low-tech giants, the theme is the same: substance. Real wealth is not found in the hype. It is found in the plumbing. It is found in the companies that provide the electricity, the companies that shrink their share count, and the companies that execute simple business models with ruthless efficiency. Don't let the headlines distract you. While the crowd is chasing the shiny object, I want you to look at the ground beneath it. Look for the infrastructure. Look for the cash flow. Look for the lungs of the market. Take a look at your portfolio today. Are you holding the gold miners who might not find gold? Or are you holding the ones selling the pickaxes, the electricity, and the lunch to the miners? The answer to that question will determine your financial future for the next decade. If you found value in this deep dive, make sure you are subscribed. We are going to keep uncovering the mechanics of the market that no one else is talking about. I'm Sean. I'll see you in the next one.